Global markets head into Thursday with a more defensive, inflation-sensitive tone as geopolitics again dominates the macro backdrop. The key driver has been fresh concern around Iran and the Strait of Hormuz, with reports that U.S. military officials will present Trump with new options for action, including strikes and operations tied to Hormuz, helping push Brent to a fresh war high and keeping oil at the center of the cross-asset story. In FX, the dollar is firmer as higher oil Fed hawkishness post the FOMC decision and geopolitical risk all reinforce demand for U.S. dollar liquidity. Dollar yen is again the standout, pushing above 160 as the yen weakens under the weight of higher energy costs, widening policy divergence, and the absence so far of fresh verbal intervention from Japanese officials. The euro and pound are more event-driven, with both the ECB and Bank of England expected to hold rates today, leaving the focus squarely on Lagarde and Bailey and whether they lean into inflation risks or growth fragility. China data added another layer to the macro picture, with manufacturing showing resilience but domestic demand still clearly soft. The official manufacturing PMI held above 50, while the private PMI surged to its strongest level since late 2020, suggesting export-oriented firms are still holding up. However, the drop in non-manufacturing back into contraction highlights weakness in the domestic economy. Elsewhere, commodity-linked FX is under pressure despite strong oil, as higher energy is being read more as a global inflation and growth shock than a clean terms of trade positive. The New Zealand dollar has been hit by a collapse in business confidence, while the Australian dollar remains vulnerable after the recent Fed-driven dollar rally and mixed inflation signals. The major risks ahead are the ECB and BoE decisions, Lagarde and Bailey's tone, and any escalation in U.S.-Iran headlines. If central banks sound more worried about inflation, the dollar and oil could stay bid while equities struggle. If they emphasize growth risks, markets may briefly stabilize, but the broader tone remains hostage to Hormuz, energy prices, and the next signal from global central banks. That's all for now.